conversation, what I want to share with you guys is something that I thought would be very timely as well as very important for you guys to hear, considering that we're at the beginning of the year. And obviously, at the beginning of the year, it's a time when most individuals are looking to really identify what their goals are, identify what their uh, um, true mission is with regards to making sure that they are successful, whether it's in their personal, individual, or business efforts. So on today's topic, what I'm going to be discussing and sharing with you guys is very important as it relates to the health of your real estate investments. And the way that I actually came up with this particular topic, ironically, is related to my personal health. And I think I had shared this with you all on last week's call, but I had been noticing some slight tension and pain in my back. And initially, I just thought it was a slight tweak that was going to wear off or eventually resolve itself after a couple days or so. And a couple days turned into a week, and a week turned to 2 weeks. So I eventually decided that, hey, I actually need to get this looked into. So just a few days ago, I actually uh, visited my doctor and performed an initial conversation with the nurse. And upon this initial conversation, after expressing what my concerns were, what my pain and feeling was, the very first thing that the nurse did was she actually took my blood pressure. And after she took my blood pressure, she gave me my reading. And pretty much that is what started the whole conversation before I was able to go to the next level with meeting with and having a conversation with the doctor. And in my mind, that actually had me think of a situation in which kind of relates to my business and potentially your business and your real estate investments. The importance of that blood pressure reading was that it was going to give an initial diagnosis to alert the nurse and the doctor if there were any specific situations going on that could be more serious or more severe than my back pain. And ultimately, when you're looking at a blood pressure or reading a blood pressure, you're looking at a couple numbers. You're looking at your top number and you're looking at your bottom number. And if you're just looking at one number, it can give you an indication of potentially what health situation or concern could be. But those numbers really need to be in conjunction with each other and used together. And as I was going through that process, I thought about the scenario when it comes to keeping track of your financials and keeping track of your business activity. When you're looking at the health of your particular business or your particular investments, similar to how we track our health by taking an approach of looking at a blood pressure, we would do so by looking at our financial statements and looking at the activity of our financials as it relates to our business and or investments. And rather than measure the success or the state of our investments or business by a blood pressure read, we actually do so by looking at something called KPIs. And KPIs is short for key performance indicators. So with a key performance indicator, this is going to essentially do the same thing as a blood pressure read would do for identifying your health. You would ultimately take a identified metric from your financial statements to determine whether you're successfully investing in your real estate business or if your portfolio is successfully performing to your needs. So similar again to our health, physical health, we also should be keeping track and mindful of our business health as well. And we do so by obviously being in tune and keeping track of our financials. So um, to kind of give you an update, I eventually had the conversation with the nurse and the doctor, and turns out that I ultimately need to just stretch more and work on specific stretches towards my back area. And as simple as it sounds, it actually turned out to be better than I expected, because now that I have three little kids, I'm oftentimes very active moving around, picking them up, tossing them around. So I likely tweaked something in one of those activities, but the good news is that it was nothing too serious. So um, wanted to just share that with you all. And that's actually what prompted me to actually have this conversation with you in terms of whether or not the health of your real estate investment and or business is in a good state. So what I want to do with this call is really, or this conversation is really discuss a few key indicators and terms that you all should be familiar with when it comes to your real estate investments. And you can obviously apply this to your real estate investments, but you can also apply this to any business, really. But for real estate investors and businesses, these 10 metrics are going to be really important for you to identify whether or not you're making a good investment or whether or not your investment is performing to the best of its ability. And really, in order to do any of these analysis and evaluations, you first and foremost need to have your financial statements. You need to have good financial statements, and you need to have current financial statements. If you're in a situation where you do not have financial statements that are readily available, that are produced on a regular basis, month in, month out, chances are you're not able to really keep up on top of these measurements that I'm going to discuss. So without saying, it's really, really important that if you have businesses, if you have investments, and you're looking to really analyze the activity and performance of those investments and assets, you first and foremost need to have the basic compliance structure in place, which is keeping track of your financial activity. And you would do so by doing something as basic as your bookkeeping. Keeping on top of your bookkeeping is really going to help in being in a position where you can take it the next step and now start to analyze the activity of your investments or your portfolio. All right, so I'm going to actually go over a few of the metrics that I think are the most important and that you guys should be really mindful of and measuring. If you're a real estate investor and or if you have real estate investments in a portfolio. And as I go through these, I just want to remind you all that similar to a blood pressure read for your physical health, what we would equate that to in terms of looking to measure your investments is something called a KPI. So a KPI is a key performance indicator. And by definition, it is a quantifiable measure that can be used to estimate an investment's performance and success. And you'll use KPIs specifically for your financial statements, but you can also use KPIs for non-financial statement measurements. And what I'm going to talk to you guys about today are going to be your financial statement metrics, but similar to how we measure financial statement metrics, we can also measure non-financial statement metrics. And what I mean by that is anything on your financial statements, we can essentially use that information to determine KPI measurements. And anything that will be pulled from your financial statements would be considered financial statement KPIs. However, there's operational KPIs that we could measure as well. And the operational KPIs is going to be derived from information not necessarily received from your financial statements per se, but outside of your financial statements. So what I'm going to focus on as we continue our conversation are going to be the financial statement KPIs. So obviously, it's important to know your numbers. It's important to keep on top of your financial statements. But really, in terms of the importance of really understanding your numbers, this is really important because it will help you determine the current success rate of a particular property, a particular investment, a particular business. If you're able to determine the success, it will give you the information that you need to continue to do more of the good that you're doing to be successful, or it will give you the information that, hey, you need to actually make some changes or reconsider some things. So without really having financial information available to you, it's really difficult for you to really understand if you're using your investment at the best possible way that you can in terms of the performance and success. Now, when it comes to real estate, almost all real estate and real estate investments have metrics that we need to really keep track of and identify. And if you're unfamiliar with these metrics, then chances are you're going to make a mistake or you're already making a mistake. So let's get straight into what these metrics are. So one of the metrics that I think is really important for you all to know is referred to as the return on investment. And this is not a new one for a lot of you, but return on investment is also known as an ROI. And the ROI actually measures the profit that you make on an investment compared to what you actually spent to acquire the investment. So pretty much in real estate, your property's ROI is the total amount of earnings that you receive after you subtract all of your expenses and all your loan payments. Now, after you invest in your real estate investment or asset, it actually may take you a little while before you start to see a positive ROI. And if you've actually calculated this number correctly before going through with investment, you should actually have an expected time period for when you should see a positive ROI. So this is a really important as well as also pretty basic metric that you should be keeping track of when it comes to your investments in your real estate portfolio. Another one is called net operating income. So NOI, net operating income, this is pretty basic as well, but very foundationally important. This is your net operating income from subtracting your expenses from your income. And if you have positive income, you then subtract your expenses, and this gets you your NOI. If you're familiar with what the NOI is for a particular asset for your overall business, then you really understand what's driving your revenue, and then you also understand what's driving your expenses. And obviously, if you're in a positive NOI, that means your total revenue is better than all of your expenses, which gives you a positive NOI. And obviously, as an investor, you want to make sure that any investment that you have when it comes to real estate is generating and producing positive NOI. Another metric that may not be so basic or familiar with some is referred to as your internal rate of return. So with your internal rate of return, what this is your property's internal rate of return. Actually, let me take a step back. It's actually similar to your ROI, but there's one key difference here for our IRR. Your internal rate of return is really the annual return on your property versus the property's current rate of return. So it's very similar to your ROI, but if you're looking to annualize and look at what occurred throughout the full year, then we typically are going to look at the IRR metric, which is your internal rate of return. All right, so another one, I think this is my number 4 here. Number 4, we have your cap rate. So some of us have heard the word or the term cap rate thrown out there, but probably really don't understand what it means. This is pretty much your property's capital rate is an evaluation of your property's expected ROI, along with any possible risks that may be contained within that investment or property. So one thing to note when you are looking at your cap rate, it doesn't include debt such as loan payments. So if you have a mortgage on this particular investment, we're going to actually back out any of those factors when we're looking at your cap rate. And when we talk about a cap rate, obviously it's a rate, so it's a percentage. We're looking at a specific percentage on the investment. And for example, if I said cap rate 50%, what that means is I'd expect 50% return on my investment property or my investment portfolio. That's an example of utilizing the example of the metric cap rate. So far, I talked about a couple basic ones: your return on investment, your net operating income, your IRR, which is your internal rate of return, and your cap rate. For number 5, we also have cash flow. So cash flow is pretty straightforward, but I just want to make sure everyone is familiar with cash flow being not necessarily the same thing as net income. Cash flow is the total cash flow of your monthly profit after all of your expenses and bills are paid off. So if you are, for example, owning a building, apartment building, and you're collecting $10,000 in rent on a monthly basis, but you spend $6,000, whether it's on operating expenses, bills, mortgage, at the end of the day, after you spend that $6,000, you now have $4,000 left over. So that's an example of cash flow. That may not necessarily be your net income, but that's your cash flow. So just keep in mind that there's a difference between the two. Let me make sure I'm keeping track of my account. I think I'm on number 6 now. So another metric that we now want to share with you guys is cash on cash return. So your cash on cash return actually analyzes the total amount of cash that you've invested into the property versus your return that you're getting on the property. And this is also going to be displayed in a percentage form. So in other words, your cash on cash return equals how much money you're earning off the cash you invested. Another metric to keep in mind is your operating expense ratio. Now, your property's operating expense ratio measures your operating expenses compared to your operating income. And an example of operating expenses are going to be things such as your maintenance, your property taxes, your insurance, your property management fees, utilities. Keeping track of this is ultimately going to make sure that you're in line with what you expect your expenses to be on a month in, month out basis. And if you're in a situation where those expenses get out of whack, then if you're keeping track of this particular ratio, then we could potentially dive into the actual KPI specifically and identify a specific property or a specific investment that's throwing off the equation if we're keeping track of it. So this is an important one. Obviously, it's relating to your expenses. And then I have debt service coverage ratio. This is also known as your DSCR. Your debt service coverage ratio determines your ability to pay your mortgage by measuring your cash flow. So if you know your cash flow, then you can obviously calculate your DSCR. And when you first start out with a high risk investment, you want to really pay close attention to this particular metric because you can easily calculate it by dividing your net operating income by your total debt that you owe on the property. And your total debt actually includes the principal that you owe for your loan or your mortgage and the interest on the loan and what the tax rate is. Why this is important is because if this calculation gives you a number that's greater than 1, then this indicates that you're able to actually pay off your mortgage or pay your mortgage. And then for every increment that's higher than 1, this actually is going to represent your total cash flow. So if you're at 1, you're essentially breaking even. You can pay the mortgage, you can meet the bill, but each increment above that means you now have positive cash flow on top of that. And then on the opposite flip side, if you have a negative number or less than 1 number, then chances are you're in a situation where it may be a stretch for you to consider affording this particular investment or asset. So these are just some a few API metrics that I think are really, really important for you all that are investment or owners of investment properties, real estate portfolios, and for any business in general. Right? If you understand these metrics and you're keeping track of these metrics, then it will empower you to be in a position to be able to analyze the operating performance of your property and whether or not you're doing good by the property or whether or not you need to make some changes. And oftentimes, if you're on top of these metrics, chances are, if they're working positively for you, chances are you're probably pricing your rents correctly, you're probably purchasing correctly. But if they're not working in your favor, chances are you need to evaluate whether or not your revenue is consistent with what it needs to be based on what the market shows. Maybe we need to consider adjusting your expenses, or maybe we need to consider your investment decision overall. Without these metrics, it's really difficult to give you a definitive, this is what the general market is, this is the average of what we would expect, and this is what you're doing. Without those numbers, you can't make that determination or decision. It's just a matter of you pretty much going blindly about the process. And as I stated before, in order to really maximize these metrics and these numbers, you ultimately need to have your basic financials in place. And what I mean by that is you need to have your basic bookkeeping, you need to have your accounting in place so that the information that is generated is timely, it's consistent, and it's done on a regular basis. And if that's the case, you can essentially take your financial statements, you can take your profit and loss, you can take your balance sheet, and you can now start to calculate these numbers and these metrics. However, without the basic financial statement, profit and loss and balance sheet, you're not able to come about and move forward with what we're talking about here. So I wanted to share this with you all, and I thought this was really important. And this was all sparked by my visit to the doctor and getting my blood pressure read. And ultimately, similar to how we can identify the health of our physical being by something as simple as a blood pressure, you would do something similar with your business and your investments by looking at your KPIs. So for a real estate investor, business owner, these are equations and formulas that are vital, they're necessary if you're looking to really make informed decisions and utilize your actual numbers to guide you with those decisions. I hope you guys enjoyed the conversation. This is actually going to wrap it up for this talk. If you guys have any questions, any needs, or looking for any guidance regarding the process of making sure that you're in a position where you can actually identify and prepare your KPIs, or if you need to identify which KPIs are important for you to keep track of, feel free to reach out to us.